Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to episode number 27 of the Wall Street Lab podcast. And this week we are talking about alternative investments. Very exciting topic. Leo, why don't you tell us a little bit about our guest this week?
Sure. So Andy spoke to Joern Czech, who built a career in investment banking at Goldman Sachs and Deutsche. Then he moved to a hedge fund and recently founded his own firm called Ianua, which caters to family offices and seeks to find direct deals in private equity, venture capital, and the real estate space, as well as build a network of families that to enable them to speak and exchange ideas with each other, which is something really interesting. So, Andy, why don't you go ahead and tell us what exactly you guys talked about in the interview?
Yeah, Leo, that was a good intro of Joern. As you see, he can give some great advice on how to network properly and how to get into the industry. And he tells us how he found the credit crisis and the financial crisis from inside the system. He then speaks on the difference between working as an executive at an investment bank, which is not a 9-to-5 job, as you can imagine, versus being his own boss, being an entrepreneur. Of course, we dive deeper into alternative investments, into increased complexity, lower yields, real estate, and Ianua. Be excited. It's a really cool episode. Have fun.
Awesome. And now, without further ado, let's jump in.
Hello, Joern. Hey. I'm very pleased to be here with you in your beautiful London office. So just to give you listeners an idea, we're just sitting above Oxford Street, brand new offices. So I'm really excited to be here, to have you on the show. Let me start, Joern. Can you tell people a bit what you do? So imagine my grandma's visiting and she asks you, so Joern, what do you do? What would you explain my mom or my grandma, somebody has nothing to do with finance?
That's a very good question. First of all, thank you for inviting me to your show. I'm asking myself every single morning, what do I actually do? Actually, explaining it to my grandmother wouldn't be that easy, other than, my grandson is doing finance stuff. And I started off in fixed income, and all my relatives, especially my mom and grandma, always told everyone, okay, my grandson is working in equities at a stock exchange. Because it was the only tangible thing they could think of. But what we're doing right now is we're building a fintech startup company here in London. I'm working in the finance industry for quite a while. The time was right, the market was there, the demand was there. So we said, okay, now it's time to move on and to build something from scratch to cater towards a certain need of certain clients in a certain market field, in this certain financial environment.
That's a lot of certainty.
Yeah.
You said fixed income. Is that what you did before? Can you tell us a bit what you did and how you ended up where you are today?
I was starting as a fixed income trader, believe it or not, in the late 90s, in a small private bank in Germany. I then moved on to become a salesperson at Deutsche Bank, traveling between London and Frankfurt back then, covering actually German insurance companies and pension funds, so helping them to invest their money. And after Deutsche, I spent a decade at Deutsche Bank, Global Markets Division. I moved on to another bank, doing pretty much the same, still working with insurance, pension funds, really institutional investors, to help and support them investing their money. And as we all know, they cannot just go to the next bank branch and invest their money like everyone else. There are certain regulatory rules, there are legal rules, there are internal things they have to consider. And taking all this into account, there was a lot of financial engineering involved, really to tailor certain investment products to the very needs of the insurance and pension funds. After that, I moved on to another bank, as I said, and left the banking side in 2012 when I joined a hedge fund here in Mayfair. It was a Deutsche Bank spin-off. It was getting more bespoke and more detailed and more niche-y in the structured credit world. So out of this huge fixed income universe, we picked out one specific part of the investment market where we thought we were excelling and we were a perfect fit for our investors. I was heading their business development and marketing team, spent there 6 years. until just recently I teamed up with a partner of mine that I met over the course of the last years and said, okay, now it's time to move on and to get even more niche-y. Now, as you see, there's a common kind of a trend, I could always say. Starting in fixed income, getting more into the structured credit world. And now we're tackling alternative investments and helping especially professional investors, but less the institutional, more the private side, let's say family offices. So one day you, Andreas, and your fellows in the background, when you sell the Wall Street podcast, you may come to me and ask, okay, what do I do with the money?
I'll definitely invest my money with you then. It's really interesting. So much to go through. Was there a particular reason you went through this way, or just like you always saw an opportunity and then you dove deeper into where you were interested most or where you saw the most market opportunity?
In hindsight, it looks, especially from the outside, it looks like a natural progression, doesn't it?
Mm-hmm. Yeah.
But it was not. It's rather that you getting more involved in what you do, as you usually should do, right? You're starting as a generalist, become more specialized, and you're interested in what you're doing in the best case scenario, and then you just see opportunities. And if you take the years, there was a lot of uncertainty in external factors. If it's the dot-com crisis at the beginning of the 2000s, if it's the 2008-9 credit crunch, if it's other circumstances in the market where you just have to adapt, or where I just had to adapt. And this is one side. And the other side is you as a person, you grow in the best case scenario again. You grow in the sense of that you're getting more knowledge, you get to know more people, you get more experience, most and foremost. For some people, not for everyone, but for some people, then there's a certain time in your career or in your life where you say, okay, what do I do now? Do I want to do something on my own and really put everything that I learned over the last 10, 20 years and build something? Or do I want to continue what I'm doing? It's not right or wrong, but just a different path.
What did you learn over the last years to share with our young professionals, our students that you started? Anything, especially like from all the different roles, trading, sales, structured credit, anything you particular stands out?
I mean, if I look at my team right now at Ianua, it seems they learn nothing because they're way smarter than I am. So I am the low-hanging fruit, definitely. Of course, you learn a lot in your profession, in the markets, knowledge-wise. If it's structuring, if it's sales, if it's trading. But what is more important, for me at least, was dealing with different characters, dealing with different people. I mean, you know all these war stories about very egocentric, or let's call it special characters on trading floors. It's all true.
It's all true, all right.
All true.
I'm really excited to hear some of those stories later.
Later, for sure, but not now. No, of course, in dealing with those and adapt to those situations, to those persons, to those people, and it's a high-octane environment where there's a lot of professionalism to a certain extent, in the sense of that your clients' demands are extremely high. And if you cannot deliver, they go next door. That easy. It's a little bit different than in the retail sector. If you go high street shopping, if you buy your next jacket, and the salesperson, he may care, he may not. But the next one is just around the corner and buying this jacket if you don't.
Mm.
It's different in the institutional world for investments. So if you can't deliver, or you don't deliver, or you're too late, or you're too lazy, or you're not knowledgeable enough, next bank waiting.
You went through the dot-com crisis. You went through the financial crisis.
Makes me old, doesn't it?
You hold up very well. So, but can you relate some stories? Like how did it feel from inside the bank?
I mean, where do I start? I mean, we're talking about, I started back in 96, so it's quite a few stories. But the most scary ones were actually around the credit crunch, because this was something that no one has seen before. And sitting on the trading floor and seeing your senior guys coming back onto the trading floor from the outside world, telling everyone, I just bought gold bars in the next branch, or I just bought a farmland out in the middle of nowhere. Sounds funny now, wasn't funny back then. Because if this guy, being in this for 20 years, is making some ridiculous choices in terms of investments, like gold bars, really? Not really productive. Farmland, okay, if you want to retire and you love what you do, okay, but do you really think you can sustain yourself? Good luck. But this was really scary. A very good friend of mine, he was at Lehman back then, and we all almost had a constant telephone call between him and I over the weekend. And it went that far that he was saying, okay, I have all my money in the bank account on the Channel Islands, which was a typical thing here in London if you're an expat. But what if I can't get hold of my money? What do I do? Do I go out on a shopping spree now over the weekend and buy expensive stuff that I can actually trade in later on again? But this was not funny at all, because these guys, of course, we made a good amount of money, it was a good salary, but don't forget, most of it was paid in equity, in stocks. But some of them lost their complete pension, lost everything. So this is not public knowledge in the sense of that the media is actually picking that up. And this was the situation of my friend, actually. He was my age, and we worked a lot, and we had a lot of equity. So the equity, the stock from Lehman was wiped out. So this was gone. So of course you have some savings, but if the savings are not safe anymore, what do you have?
And not all on the street, probably people were kept continue shopping here in Oxford Street because they had no idea.
This was an awkward situation because you were just leaving the trading floor, going outside just to get some fresh air. And the world was still running as it always does, which was getting you down and humbling you on the one end, and chilly on the other side. There's no one seen what's going on there.
Can you explain to the people what happened during the credit crunch? What was so scary for all the super senior bankers?
I mean, you probably have read and seen all the movies about the credit crunch, what happened. But it all started in the US, where you just put lousy mortgages that are not checked anymore into products, into another product, just that no one actually sees what's behind it anymore. And of course, when the mortgages turn sour, defaults go up. And then there was a big spillover into Europe. This was on the one end. On the other side is that suddenly there's a huge interbanking market where banks lend money to each other just to offset certain surpluses or to level out certain day-to-day activities on the cash side. And it dawned on some of the market participants that it's better to keep the money in-house, and maybe not giving money out to every bank around the corner anymore. And that's what actually happened. So suddenly the whole market was just drying up. No cash available anymore. And as we all know, if there's no cash available, there are some shortages. And this actually, this is a very, very simplified version
of
what happened. The last the last rescue would have been the politicians or the government stepping in, like in the US, when they talked about, do we want to rescue Lehman? Because no one is lending Lehman money anymore. No matter if it's right or wrong, no one was lending money anymore to Lehman. And they could not foresee the implication that followed after, how interconnected the market already was. If one domino stone actually falls, like Lehman did, suddenly all the other situations that came after, like the cash was still gone. There was still no cash amongst the banks being readily available just to support as in the cash management business before. And suddenly there's a situation where all the banks just care about themselves. Then we all know that in Germany in particular, politicians step in front of the camera and said, hey, there's nothing to do with you retail folks. You can still go to your ATM and cash in whatever you like, whatever you need. But in reality, it was not that easy, because there's more money out there than we have cash available. Let's face it.
Of course.
And we don't have so many bills that we can everyone can go to the bank and say, okay, I'll get all my money I have in the account. I want to have it in cash to put it under my pillow. It's just not doable. The banks work with certain assumptions. So how much money do we need in cash? And suddenly it's not available anymore. So it could have been way worse. It was bad. And we still see in all our day-to-day lives, if it's the political landscape, if it's economy, if it's the media landscape, what followed after.
The people saw only the tip of the iceberg, right?
Yeah.
That's been some really crazy stories that must have been going on there. And then, is that one of the reasons you said, okay, I want to do more in real assets or alternative investments, or?
I think it was rather different the other way around, that I was interacting with investors asking me, could you guys please help me in analyzing certain alternative ideas that's been presented to me by a bank, a broker, another family, a fellow of mine. And being on the hedge fund side, of course, we could do it in our specific role, in our niche, but we've always been perceived as, hey, you're biased, right? You're selling your own product. So we figured out there's no neutral or more neutral company or party out there who is helping to fully analyze certain investment opportunities. So it was rather this situation that I teamed up with my partner than me just saying, okay, where do I want to go to now after what I've experienced in the past?
It was more forward-looking, more seeing where are the opportunities.
It was rather me being pulled to one extent and then doing the step myself and taking the step and say, okay, now it's time. Rather than me just saying, I want to do something on my own. So what can I do? Where is the niche that I can actually fill?
You said earlier it's the right time for it. What makes you believe that it's the right time now to do something like that?
I guess all the listeners play with the idea of, or most of them play with the idea one day to be their own boss and to do something on their own. I think the whole way of starting your own company is way more democratized as it ever been, let's put it this way. When I was younger, there was no thought about, okay, doing something on my own. Just went to a big bank or to a larger institution, then you go your way. But these days, with the technology on one end, the knowledge on the other side, the exchange of knowledge amongst people, friends, colleagues, and what have you, just what it takes to make a company or to build a company, it's way easier accessible than in the past. And I think this is an important step. And the next one is that in my specific case, in the alternative investment space, usually you talk about the equity market, fixed income market, real estate market, and other markets. After the credit crunch, all these markets are more and more merging into each other. So the boundaries or the borders are blurring to a certain extent. In the sense that I, as an investor, I do not have this absolutely clear separation as it used to be. That's number one. So there's more interest and more demand for alternatives.
And also correlations are going more and more in the same direction towards one, right? So asset classes move more and more together. I think in the last year, we have seen so many asset classes going down at the same time, which never happened before. Like there was always some kind of asset that moved up in some way. If it was equities going down, bonds moved up, or gold moved up, it's like everything went down. Even what was perceived to be super uncorrelated like cryptocurrencies, everything just moved down. Can you tell a bit more about what is alternative assets and also how investors are trying to get more alternative basically every year?
I mean, to pick up your point regarding the correlation, this goes hand in hand with the hunt for yield. As we all know, we were living in a low yield environment for quite a while now. So the need and the demand is there just to show for other assets that yields more than just 3-4%, but not extraordinarily increasing your risk simultaneously. So how do I do that? If you stay on the very top of fixed income equity, they're all the funds that offer whatever they do. They're good managers, they're bad managers, like in real life. If you're a professional investor and you have more money to spend, you go more the bespoke route because you have more options to do than just going by a fund. Or maybe you're buying the underlying what a fund usually would buy directly yourself. Maybe it's a real estate fund, you may end up buying your own real estate portfolio. If it's a private equity fund, you may go out and buy your own companies in a certain industry with a certain expertise and so on and so forth. Coming back to what is alternative, it really depends on whom you're talking to. To some people, private equity funds are already alternatives. To some, hedge funds are already alternatives. To us at Ianua, we go to the very bottom of the underlying. What do these funds actually buy at the end of the day? And this, to us, is the alternative asset. Scrapping away all the layers of a fund as a shelf, a fund as a manager, or SPVs or other kind of vehicles actually combine all the assets to make it investable. We scrap it all away, and we then help our investors to fully understand the underlying asset in itself.
Can you give some examples of what is on your platform and how exactly do you do that? How can you manage to scrap all those layers away? I mean, they are mostly there for a reason, right?
They're there for a reason to make certain asset classes accessible on the one end, right? In a hedge fund, they're saying, okay, we are an expert in this very field, and you give us 2% management fee and 20% performance fee, and for that, we are managing your money. Some families, some professional investors, they say, we don't want to pay you 2 and 20 because we may have some expertise ourselves. What we're only lagging is, given that we are a team of 3, 4, 5 people only, to have someone assisting us and supporting us in our own due diligence, but on a deal-by-deal basis. You see all these research houses and macroeconomic research. There are tons out there, again, good and bad. But who's actually helping and supporting you on a transaction to fully understand and to make a institutional level analysis or due diligence that you as an investor, as a family office, as a professional investor actually can use to make your informed decision at the end of the day. This is exactly the niche that we're actually stepping in and saying, okay, we have a talented in-house team. We are 7 people now. We are growing, number one. Number two, of course, we do not capture the whole alternative markets yet. We're concentrating on certain subsectors.
Mm-hmm.
And this is a function of what our investors, our clients actually are demanding or looking into or interested in at the moment. And over time, we're adding further people, further research people, further analysts to our team that we grow with our clients when they're shifting their points of interest from real estate into something completely different.
What are the hot topics at the moment? What are your clients interested in? What are they looking for at the moment? Can you share a bit?
I would summarize it in 2 sectors, broad sectors. One is real estate. It doesn't come as a surprise. And in real estate, everything. Brown, greenfield, bridge financing, equity, debt, you name it. Which in itself is already a vast task just to capture the real estate space in this particular instance. And the other large sector is the corporate finance world. Where any company is looking for money, either in an early stage, like a pre-seed, seed, or ABC series, pre-IPO, what have you, or acceleration or growth capital. And that's why we, for instance, teamed up with the Department for International Trade of the UK, just to help them and support them when they're talking to investors, to add this extra layer of neutral, institutional level analysis and due diligence. These are the 2 major asset classes within the alternative investment space that we are concentrating on.
Do you see any asset classes that are on the rise for like next 5 or 10 years? Something that people should watch out for when they get their education, that you look a bit in the future, because most of our listeners are really young. So they try to see what's coming up. Anything you find particularly interesting?
I think there are 2 questions in one, right? One is, do I see a certain asset class that may perform better than anything else going forward? And one is, would I actually base my career on this asset class? Number 2, I would never base my career on an asset class. It's my very personal view. Do I see an asset class emerging in the next 5 years? I probably would be sitting on the beach somewhere else. And the markets are, in my view, way too fast and volatile to predict that a certain asset class is performing way better than anything else. And I don't know if it's a wise thing to not to compare certain asset classes, but to let them compete with each other. Because every asset class in its own has a certain function, let's put it. And depending on your risk return profile, even if one asset class is not performing well, but it caters to another need that you may have, security or safety or whatever. Trends that we see, for sure, everything is becoming more digitalized. Everything is becoming more accessible. That's for sure. But would I bet on startups all day long? If 1 out of 10 fail, not sure.
Okay. You said everything's becoming more digital, more accessible. Is this also a reason why this is now a good time? Because before you could not really scale outsourcing research, right? Because you didn't have the platform to really help a large client base to access those investments, I imagine.
Absolutely. Now we have a smart company in the background helping us with the front and back end to make everything user-friendly. Talk about the interface. We automate the analysis on the one end. We automate the knowledge that we gain from our investors and their points of interest on the other end. In the background, both databases are talking to each other to help us in matching and supporting. There's a lot of digital infrastructure in the background that was just not available even a few years ago. And you're right, absolutely.
You've had a very long career, very finance-driven career. Now I'm really curious, how is it to start your own company? What's different compared to a big bank?
It's worse than I ever expected. In terms of workload, forget everything that you've done before. And I thought I was already working in a hard working environment with the 2 banks I was working for, or later on the hedge fund. But this is nothing compared. So now it's really 24/7. And the major thing that is different is the sheer amount of different tasks that you have to deal with every single day, every single hour, every single minute. That's different. Do not have any people or person you can delegate it to. Now you have to deal with the infrastructure. The next very minute you're talking with the lawyers on the contractings. The very next minute you have a meeting with an investment provider. The very next minute you go to Amazon just to buy the screens online. So it's quite diverse. It's thrilling and it's a lot of fun, but I'm also looking forward to the minute where loads of things are operationally done, that we now can really start and building out the company more strategically.
I can imagine. But are you still happy you made the step out of the corporate world and into being your own boss?
I would even say there's no way back anymore. I'm spoiled now because I only have to justify myself within the team. And we all align. There's no hidden agenda, not much politics around anything, because we just want to build something great and to help our clients. It's always different in a bigger organization, but there's so many politics and situations that you do not just see from the outside. And this is something that I do not miss. And I don't want to never say never, but I rather want to make Ianua a global company than deciding which bank I want to work for going forward.
Can you, to the people that are starting out, give some advice on both, how to get along with politics, how to deal with politics, and on the other side, how to maybe decide what they want? Do they want to do a startup? Do you want to go into corporates? I feel like you have so much advice to share. I'm probably asking a lot of advice questions now. If you have any advice for corporates.
It's very bespoke, isn't it? And very, very personal.
Absolutely.
I mean, giving advice to a larger audience in this particular field is quite difficult. Now, you have to listen to yourself, what you're really into. For me, when I started out, I may have had the entrepreneurial gene or DNA already in me. I don't know. But starting out with larger banks helped me a lot. Just to fight my way through and to survive in a bigger environment, to learn a lot, to grow on your network massively, which helps. All experience I can use now. So if you as a person want to know your own little path, do you want to start out with a bigger company or a smaller company, or even doing it on your own? There's so many variables. Very difficult to catch from the outside. Like I don't know who I'm talking to. Right? It's a larger audience, as I said, and not least financially. Can I afford starting my own company, having no income for 2, 3, 4 years? It's a very personal question.
You mentioned a very good point, networking. Can you give some advice on that? Advice on how to build a good network, what to do?
First of all, be kind. Number one, don't be an asshole.
I like that. This is good advice.
Too many out there.
It should be obvious, but I don't think it is.
Yeah, it should be. Yeah, you're right. It should be, but it isn't. A practical advice, there's always time for lunch. Take time for lunch. And take someone with you. Number one. If there's time for coffee, take someone and get coffee together with him. Just not only that you got to know other people, but that other people get to know you, that they remember you. Hopefully in a good way.
If you're not an asshole, they might work.
Yeah, but we had some interns where after 2 months, I couldn't even recall their names. It shouldn't be like that. There's always a middle ground. It shouldn't be like that, but it shouldn't be like you were sitting on the lap of your team member and asking them tons of questions day in, day out. So find the balance.
What do you think about mentoring?
It's a great thing. I never had one, unfortunately.
Okay. But you would try to, people get out there and try to get somebody to mentor you.
I mean, I know now that some of the bigger companies, they have a mentor program usually. Mm-hmm. When there's an opportunity, take it. If it's not inside the company, try to find someone in your own environment. Friends or older friends or maybe the parents of a friend who are in a certain industry or can help you or what have you.
I want to dive a bit deeper also into alternative investments again. Who are the players usually in alternative investments? Who are the buyers? Who are the sellers? With what people do you interact or do you find in the space? What do you have to watch out for?
On the buyer side, it's pretty much the whole institutional investor universe, which are insurance companies, pension funds, other hedge funds, private equity company, family office, this type of investor. On the sales side, it's pretty much dependent on what kind of project, what kind of alternative asset we are looking at. And it could be the real estate developer. It could be a startup company. It could be a matured company who's looking for an IPO in a certain field. It could be another hedge fund or a private equity company. So it's really the institutional world. So it's not retail buyers at all.
Do you think they will open up the market for retail buyers a bit more with technologies like blockchain, cryptocurrencies?
It already does, but not because of blockchain, but because of there are companies out there who are pooling investments. If you as a retail investor, you always wanted to invest into a KKR or Carlyle fund, I think there are companies out there now pooling investments and putting it into there. Is it a good or bad situation? I don't know. It opens up for more opportunities, but for more challenges as well. That's for sure.
I mean, all the alternatives, they have high risk, long investment times. Many can get trapped in things they can't actually see through properly.
And that's the important point, the complexity. I wouldn't put risk at the very top of challenges that you face because the risk, most of it you can't see right away because the whole thing usually is quite complex. That's why we have a team of analysts sitting here. And they're doing it for 10 years plus. The complexity, this is exactly what you get paid for. For the higher return usually comes out of the higher complexity, less liquidity. All this combined, depending on how you want to calculate, is then going into kind of risk associated to it. You're right. But I rather fear that people do something that they do not understand. Taking aside the risk element, taking aside the yield element, just concentrating on complexity. Just because I'm able to buy something doesn't mean it's right for me. Again, like in real life.
Do you think alternative assets got more or less complex over the years?
They were quite complex during the credit crunch, that's for sure. And it's a hard question to answer because if you work in this industry for such a long time, things that might be obvious to yourself and easy to understand because you do nothing else all day long might sound completely esoteric to other people. But in general terms, there was a tendency to get things less complex. But let's face it, the financial markets and all the different disciplines, they are not easy, they are not simple.
Absolutely. I feel like in the equity markets, things are getting more and more complex. Now you have high frequency trading, you have black boxes, now you have more and more players coming in, and everything's just moving at such a fast pace. I was just wondering if in alternatives that's the same, or do you see anything else that changed in alternative investments?
That's a good question. I mean, you're touching upon the point of velocity or speed of trading. It's a completely different discipline in itself. Going back to complexity, what we definitely see is that there's the need and demand for support to better understand stuff. Maybe it's as complex as it used to be, but the situation changed that the professional investors are more aware that they need more support in understanding certain instruments, certain asset classes, certain investment opportunities, more than ever before. And they may not have the bandwidth internally to fully grasp what complexity means in this very investment opportunity, if this makes sense. But this has changed for sure.
I think it does because probably earlier, as you said, you didn't have companies like yours where everybody could buy a house or a villa or something themselves, right? They had to invest in a fund, they have to give it to them. But now I imagine also in alternative investments, yields go down, right? I see there's more and more retail investment projects, even in real estate, where as a private buyer, I can only speak as a private buyer. A couple of years back, you can cut 5, 6, 7% per year. Now you are like 2 or 3% a year if you're lucky. And I imagine the institutional space is not so much different. So you have to save costs. You can't just like give some hedge funds, some private equity fund, some real estate fund, give them some bunch of money, pay 2% fees, as you said, and then still get a reasonable return. So there has to be a better way. Is that probably how it also was influenced?
We do see yield compression everywhere. And if I look, especially in the high yield markets, so corporate bonds, for instance, or corporate loans that are not investment grade, but below the spread or the risk premium that you're getting for investment into it, for me, it's ridiculously low. But on the other side, how do you actually boost your yield? Either you go further down the capital structure in terms of adding more risk or getting a lower rating, or you say, I do not need a daily liquidity, so you get a liquidity premium, or you just say, okay, complexity I'm not scared of. So you're looking into other product types which come with a higher yield because of complexity. And the last point is you do it yourself. You're not outsourcing and giving to 22 hedge funds. Say, I'm doing it myself. I have access. I'm a professional investor. I team up, like with Ianua again, in a little community of like-minded people or professional investors, and we support each other. We help each other with institution-level research as an outsourced workbench if you will. And suddenly you are 3, 4, 5% higher in your yield expectation because you just cut off so many layers of middlemen in between.
Do you see any risks coming up for the alternative investment markets in a couple of years? Where do you see the biggest threat? I mean, with all yields going down, is there anything that makes your spider senses tickle a bit?
I wouldn't single out the alternative investment market as a certain threat. It's rather the common theme in the markets. Now, if you look into into macroeconomics, what's going on with the US and China, what's going on with trade, what's going on with the regulation, now what's going on with the ability of banks providing capital to corporates. There's so many aspects in the market that I wouldn't single out alternatives per se. I would rather say that the major threat comes from the macroeconomic, almost political landscape rather from inside. If you take aside, okay, there are always non-performing loans in some markets, there are always, not always, but there seems to be a credit bubble in certain sub-markets, if it's China, if it's Italy, as I said, if it's Spain. So of course there are always risk factors within certain market segments, but as long as the investors know what they do and know what they're signing up for, if they invest into certain subsectors or investment classes, I don't see a major threat that this will be a spillover situation like in 2008 again, where everyone's uncle was buying subprime.
I heard this interesting saying the other day, politics don't have a long shadow in the markets, right? Like have a short shadow in the market, but this is really very much changing right now. Looking at Trump, the shadows in the market from politics get longer and longer and longer. Do you agree?
Depends on how you're looking into it. If you describe or explain shadow as impact in the market, I agree with you. If you describe the shadow like, okay, does the market remember what politicians or certain situations have created? I think the memory is still short. Look at the emerging market, there are defaults all over, countries defaulting almost on a 5 annual basis sometimes. And there's still money going into these markets.
I want to be respectful of your time. Is there anything that you want to leave our audiences with for the end of the session? Anything you want to share? Any last advice you have?
What I would say, and we'll give to all the listeners, whatever you do, do it with passion. If you're not passionate about it, try to change it. Not the passion, but the aspect, but the subject that you're working on. Switch off your autopilot. So whatever you do, do it mindful. Creates awareness that helps you throughout your life in all different disciplines.
Any books you can recommend? Anything people should get into? Any maybe on mindfulness?
Mindfulness, there are tons of books. If you take Jon Kabat-Zinn as one author, or the monk Thich Nhat Hanh, the Vietnamese monk, just look on the internet and there are tons of books about it. Yeah.
Perfect.
Start early.
One thing I need to ask still is, you say you worked as much as never before, yet you sit across me and you seem so calm, so chill. I don't have the feeling you're stressed. How do you manage your stress level?
This goes back to the autopilot thing. Switch it off, be mindful. And when I say start early with implementing meditation or mindfulness exercises in your day-to-day life, in your routine. If you're early 20s, you don't see the need yet, but start as early as you can. That's all I can say. It helps you later on a lot.
Awesome. That's some great last advice. Thank you very much, Joern.
Thank you, Andy.
If you like what you hear and we've helped you in any way, we would really appreciate it if you could go out and give us a 5-star rating on Apple Podcasts or wherever you get your podcasts, as it helps us enormously to grow this show and reach audiences such as yourselves.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.